Today we'll be talking about the March 2022 market update. Before we talk about that, let's look at the 2008 housing crash, housing bubble in context. I say this because every question I get, are we heading to a bubble? Are we heading to a housing crash? Are we having a foreclosure? So let's put 2008 housing crash in context and see where we are today to better understand the market trend where we're heading to. Rising prices alone is not enough for us to have a housing bubble. What happened in 2008 that is not happening right now? In order for us to have a housing bubble, supply has to exceed demand. In 2008, we had about 10 to 12 million vacant homes sitting in the United States. Inventory back in 2008 was at 10 to 12 months of inventory. Too many houses and very few people to buy. In today's market, I'm talking about the Texas market because real estate is market specific. And I'm talking about the Texas market. Inventory in Texas right now is at 1.4 months. That was in the month of February. In the month of March, it was even worse. We are at 1.2 months. The national average is at 6.4 months of inventory. Are we really heading to a bubble? Another key factor in 2008 was about the loan products or the mortgages that we had out there in the market. If you've been long enough in the market, you will remember products like adjustable rate mortgages. They call it AM, where your payment is little now, and after a while, it will graduate to a much bigger amount. We had no documentation loans, what they call stated income. You could say my income is $10,000 a month, and you get a loan. We had subprime loans. People with very low credit score got into homes. No money down payments. People got into homes. What measures were taken after 2008 housing bubble in order to stop some of these predatory lending practices? Policymakers and mortgage lenders, they now understand lowering the underwriting standards is not a solution for the housing market. If you look back in 2008, about 35% of all mortgages were adjustable rate mortgages. About 1/3 of all loans between 2006 and 2008 were all no documentation loans or no income loans. But today in the market, we have just about 5% of adjustable rate mortgages. So if you compare 35 in 2008 and 5% now, it tells you the mortgage industry has changed and it will not be easy for us to head to bubble. In context, if you look at supply and demand, if you look at housing inventory, if you look at the risky adjustable rate mortgages, and if you look at the Dodd-Frank laws, you will understand rising prices alone is not enough for us to have a housing bubble. Let's look at what the Federal Reserve, how they were able to get out of the housing bubble in 2008. 2006, interest rates were about 6.41% for mortgages. The Federal Reserve understood one of the ways to stimulate consumer spending was to lower interest rates. When houses are selling, every other aspect of the economy is selling. By 2014, interest rate had dropped to 3.65%. So this is how a lot more people were able to refinance their houses, got out some cash, more people were able to afford homes, and that's how the Federal Reserve they were able to stimulate the economy. And that's how we got out of the recession in 2008. I am sure the Federal Reserve is looking at a 2008 playbook with the high inflation rates. They're probably looking at that and taking some lessons and trying to be creative on how they can get us out of this high inflation. Rising prices alone is not enough for a housing bubble. In February, inflation was at 7.9%. In March, inflation was at 8.4%. Price of fuel is going up, price of grocery going up, housing going up. Where are we heading to? March 16th, for the first time, the Federal Reserve raised interest rates by 25 basis points, the biggest raise since 2018. The Federal Reserve Chairman, Jerome Powell, he said the Federal Reserve is taking every aggressive measure to combat inflation. He promised there will be 6 more interest rate hikes in 2022. There will be 3 more in 2023. So if you are thinking the interest rates now are high, be ready. We will be seeing more interest rate hikes as we move towards the third quarter and the fourth quarter of the year. Interest rates in March for a 30-year fixed mortgage was 5.12%. For a 15-year fixed mortgage, it was 4.31%. But mind you, we are talking in March. As of April 28th, the interest rate for a 30-year fixed, it was about 5.97. So if you're crying about the interest rates, be ready to see more interest rate hikes. One of the main reasons why we have a shortage in building supplies is the shortage in lumber. September 2019, the price of lumber was $285.70 per 1,000 bought square feet. In February 2022, the price of lumber was at $1,272 per 1,000 bought feet. In March 2022, the price of lumber was almost at $1,300 per 1,000 bought feet. But the good news is, April 26, the price of lumber fell to about $829, which is almost 39%. You can see the effect of the interest rate hikes. Because interest rates are going up, consumer behavior is changing. Less people are going to buy houses. The price of lumber is now going down. So the Federal Reserve, they can argue by them taking up the interest rates is having a positive effect in the market because the price of lumber is falling. And we're hoping that the price of lumber, May, June, July, by the end of the year will continue to fall. This is one of the ways the Federal Reserve is arguing they're trying to deal with the high inflation. 8.4% inflation in March, the highest since 1982 in 4 decades. New home sales actually dropped by 8.6%. So you can see there's a direct effect with the increase in interest rates. Consumer spending is falling down. Less people are buying homes. Let's look at the total housing inventory at the month of March. Although new home sales dropped by 8.6%, there was an increase in total inventory by 11.8%. New home sales dropped, but then the total number of units of inventory in March went up by 950 units. This tells you, despite the high interest rates, despite that new home sales have gone down, the total housing inventory in March actually went up. Zillow predicts we would find ourselves in the 2019 pre-pandemic situation by 2024. Zillow also predicted an annual growth percentage of about 21% all the way till December 2022 and about 17.6% from January 2023. The annual appreciation, home appreciation, is increasing. So this is still a push factor for people to get into the market. So if you would ask me what I would advise to my clients, what I tell them is, go to a builder, select a plan, and let the builder build your home. It would take anywhere from 5, 6, 7 to 8 months for that home to be completed. Each month, the prices for the builders, they are going up. I know some builders, what they do, they increase their prices for every 4 homes that they sell by $5,000. When they sell 4 homes, a fifth home, they add $5,000. So if you are building, if you lock in your price today and you're building your home, in 6 months' time, you will be moving into that home with positive equity. Not just the equity, the annual rate of appreciation is also there to help you. So no matter what is the effect of the interest rates, what you gain in equity and appreciation will outweigh what you lose in terms of the interest rates. Down the road, you can always get creative. You can refinance when things get better. Because Zillow is saying we may go to the pre-pandemic 2019 situation by 2024. I tell my buyers now, we have to be creative in our options on how we buy now. Instead of saying, oh, I'm not going to buy, let me stay and see how the market is going to go. No, you just heard from the Federal Reserve Chairman, Jerome Powell. We will have 6 more interest rate hikes this year. We have never seen this kind of a market before. I started by taking into context the 2008 housing bubble and why rising prices alone is not enough to put us in a housing bubble. Bringing you March 2022 market updates so we can all understand how the forces of demand and supply is playing to make major decisions for our home needs.